Hello and welcome to Smart Money, Dumb Money. And I am your host, Keith Richards, President and Chief Portfolio Manager of Value Trend Wealth Management. Thanks for tuning in. And this is part two of the market prognosis videos that I began last week. And we're calling these two videos, You Can't Predict, but You Can Prepare. And this is part two. So I'm going to jump right into the share screen video right now, because we left off last week talking about how the market is momentarily overbought and needing a correction. And in fact, we may have seen that correction as much as we were going to get, or maybe we get a bit more. But the big question that I left with was, are we in a bubble, and are we likely setting up for a bubble crash? And if we are, how do we protect ourselves? And that's the big question. So let me share the screen and I'll bring you back to the same slides that we were looking at last week. So I ended up with this slide, which I put on a PowerPoint. And I was saying that on my blog, I track something called the barometer, and we at Value Trend use this barometer to determine how much cash and what level of beta our portfolio should have. Now, for those who don't know what beta means, it is the extent or the relationship of your portfolio or of an individual stock to in a comparative basis to the market, how much that stock or your portfolio will move up or down versus the market. So just for an example, if you have a portfolio with beta 1, that means your portfolio will move exactly in line with the stock market. And in this case, we might be measuring it against the S&P 500. So if the S&P goes up 10%, you will make 10%. If the S&P goes down 10%, you will lose 10%. Now, if you had a beta of 1.1, that would mean that you'll make 110% of the movement up or down of the stock market. So let's say that the market went up 10%, you would make 11 with a beta of 1.1. But if the market went down 10%, you'd lose 11%. So this isn't complicated math. If the barometer goes into a higher risk level, we at Value Trend begin to reduce that beta through both raising cash and changing the sectors within our platforms to hold a more conservative beta level. For example, if you feel that the market is strong and the barometer was in the bull side of the equation on the chart here, we might go beta 1.1 or 1.2. We might want all kinds of technology stocks. We might want growth stocks. However, if we were very bearish, we might want a whole bunch of cash, and we might want consumer staples and utilities, dividend payers. These tend to be more stable companies than a technology stock or a biotech stock. So right now we're at about 3. Now I'll be measuring that again at the beginning of June. I measure the first week of every month. So that is subject to change, but right now it measures about 3. And that means that we're in a semi-risky zone, although not overly risky. And we have seen some correction, which I talked about on my blog. I had been sort of predicting that. Now the question is, last week I said, I presented some 5 factors that we should be looking out for to determine if this market is in a bubble. And if you go back to the video, or if you read my blog entitled, Are We in a Bubble?, you will see those factors, and you will probably agree that every one of those factors is in fact signaling that the market is in a bubble. However, at the beginning of my last video, I presented a chart, as I did in a blog last week, that suggested that just because we have bubble conditions, it doesn't mean that the market is about to implode. And I talked a little lesson that I learned in 1999, where the market was definitely showing bubble conditions, but it went on for another year before it finally peaked. It's a long time to wait if you sold out. And in fact, stocks went up quite a bit between 1990 and 2000. So we don't want to be caught in that situation where we miss out. And in fact, what often happens is if we sell before an actual market peak, we watch the market go up 20 or 30 or 40 or 50%, as it did in 1999, actually. Then we get frustrated and we finally go back in, and then the bubble implodes. And I'm sure some of you watching this video are familiar with that feeling. We don't want to be the last, what do they say, the greatest fool. We don't want to be the greatest fool. So I have a little methodology, and what I might recommend, if I can plug my book, I've got a couple of books out that might help people refine what we're about to talk about. My last book, called Sideways, describes the method that we're going to talk about right now. But if you want to go deeper down the rabbit hole on some of the factors I look at to determine how much we're going to sell, I am just in the midst of publishing a new book on contrarian investing that combines the trend following technique that we'll talk today with some other factors, such as sentiment indicators and even alternative data. It's a brand new subject field, and I think that anybody interested in the field of technical analysis will find this book very interesting. But just to cover the basics, this is the tail end of the bull market in the 1990s. And you can see that a bull market is identified by usually a solid trend line, as you can see here. Let's call it a 45-degree angle trend line for argument's sake. And what it is doing is making higher highs and higher lows. Markets correct every once in a while, but when they correct, they generally stay somewhere above the trend line. And in this case, they did. Now, what happens though is when a genuine bear market comes along, because people might have been fooled here about this being the beginning of a bear market, but look, this low did not take out that last high. So we had higher high, and the low did not take out the previous low. So this market was still a bull market even after this relatively larger crash in late 98. That was the Asian contagion and Russian default, or near default, of their bonds, by the way, that year. So here's what happened. The market continued making higher highs, higher lows, and then it rounded over. Now, that's fine, but it reached a low and then it rallied, but it rallied considerably lower than the previous high of 2000. So it rallied lower and it went lower still, and then it rallied again. Once again, a lower high and a lower low. Meanwhile, this red line here is the 200-day moving average. It moved below the 200-day moving average. Now you can see that the market moves below the 200-day plenty of times. So you don't just trade off the 200-day moving average, but in combination with a weekly chart illustrating lower highs and lower lows and a break of the moving average, that is one of the signals that we at Value Trend use to get out. Now, what we do is we leg out. We don't just sell the farm and run away. We understand that sometimes you get, what do the boxers call it? Head fakes. So you could get whipped out on that kind of signal, and then the market goes right back up again. And March of 2020 is a great example of that. We did sell into that sell-off, but we went right back in, and we only sold 1/3 of what we figured we would want to sell. And we ended up buying right back in as soon as the market crossed over the 200-day moving average. So that's the way you can follow a logical system and get back in if it turns out to be one of these head fakes. But in this case, this was not a head fake when you got the lower high, lower low, and a move below the 200-day moving average. So this is a pretty good system to miss out on the big moves. And in fact, we have the conditions set up for a bubble, but that does not mean you sell today. You can hang on until this type of chart formation begins to happen. And you have a system now. I again encourage you to read my book Sideways, because it'll tell you that even if it goes back above the moving average, you can go back in. All you did is miss out on a little bit of time and maybe a little bit of profit, but you played it safe. Here's another example, the 2003 to 2007 bull market that led into the subprime mortgage crash and whatnot of 08, 09. Higher highs, higher lows above the 200-day moving average. This time the moving average is a blue line. There's a peak, there's a low, there's a peak, there's a low. We had all the conditions in place, lower high there, lower low there, move below the moving average, okay? You had evidence that you were no longer in a bull market, a trending market. So again, actually in 2008, I sold out. I didn't sell at the top. And that's what everybody that wears the tinfoil hats and wants to prognosticate that they can pick these tops because their theory or their view of what the Federal Reserve is doing or whatever is bearish, and therefore we should sell now. Well, the problem with that is that a lot of the conditions like that go on, as we saw on my opening chart last week's video, for quite a while. The market can remain wrong longer than you can remain solvent. So this way, you don't get out at the top, but you do get out. And interestingly, the rules apply to getting back in, because here we had lower highs, lower lows, an ultimate washout, then a rally. This high took out the last high. There's a low. Okay, that low definitely took out that low, and we moved above the moving average. And that didn't crack the moving average here. So in mid 2009, I began to leg back in. I did my 1/3, 1/3, 1/3 rule. I never bought all at once. But the point is that I saved myself a lot of aggravation because of what I learned in 2001. And I learned to follow this system, which is why I wrote that original book on contrarian investing. My recent book is on contrarian investing. My original book that I wrote was called Sideways, and it was on trend following using systems like this. So what I am recommending is that don't predict, just prepare. Have a system that gets you out of the market. It doesn't have to be this system that I'm talking about today, but have something logical that is non-emotional, systematic, and non-opinionated. Somebody's opinion, whether it's yours or somebody else, is actually quite meaningless on the market, because the market is made up of many, many factors. People's emotions, fundamental factors, Fed moves, all that stuff is combined in a mass crowd of people trading, and machines, as we know. Your opinion doesn't matter. And I'm sorry, mine doesn't either. What matters is your system, and your system will save you from yourself. You can't predict, but you can prepare. Thanks for watching, and I hope this helped.